Hello everyone, welcome. We're just going to wait for a couple of seconds for everyone to connect, so stay tuned. Okay, I see that we have already people joining us. Welcome everyone, and thank you for joining us for today's webinar. We are going to talk about carbon, the new financial challenge, and anticipating supply chain regulations of tomorrow. My name is Daria Senani, and I'm head of marketing at Shippeo, and it's my great pleasure to guide you through the session. So just some little housekeeping. All participants are on mute, and if you have any questions during the presentation, don't hesitate to put them in the Q&A box in your Zoom webinar control panel. I will ask those questions at the end of the presentation, but really don't hesitate, just add them to the Q&A box. So I'm really pleased today of having Paul Canessa and Maxime Lambert with me on stage. So Paul has worked as VP of Customer Success for Searoutes since 2022. He helps the shipping industry stakeholders report, comprehend, and reduce the supply chain emissions. Currently serving as Director of Solution Consulting at Shippeo, Maxime is an experienced solution consultant and project manager with strong background in logistics, supply chain optimization, and technical consulting. So today we are going to talk about the new carbon and sustainability regulations that are coming in 2025. So before I leave the floor to Paul and Maxime, let's go through the agenda. As I mentioned, we will mention first the challenges of 2025 for supply chain. Then we are going to talk about the most recent carbon regulations and the impact on supply chain. Then we're going to talk about an aspect which is very important, which is the financial issues and the opportunities that companies may have. Finally, we'll talk about best practices, and this is today a little innovation because we don't do it usually. We're going to have a live demo of our product, so the Shippeo carbon visibility dashboards that we have built with Searoutes. So without any further ado, I leave it over to you, Paul.
Thanks a lot, Daria. So good afternoon to you all. Thanks for attending this webinar. I'm sure most of you work in the global supply chain, and the last years have been hectic, to say the least. Every month there's something new coming up. Port strikes like we had in the US, unplanned events such as what happened in Baltimore, climate impact making transiting through Panama more difficult, the Houthis attack that are forcing diverting around Africa, what goes on in Ukraine, of course. So it looks like disturbance has become the new norm, and as the supply chain grows more restless and more digital, customer expectations have also changed. So as a supply chain manager, it used to be a difficult job, but at least you just had to balance between cost, inventory, service, and supporting the growth of your business. But now you are a superhero, because on top of those demands, you also have to manage other items. So you have to make sure that the environmental compliance is being taken into account. You have to make sure that your staff remains engaged, and you have to make sure that all of those customer expectations are met. And so those are not like mutually excludable. Some customer expectations have to do with sustainability items. To convince you that it is not just the CSR people that are making a big thing out of it, we'd like to share this very interesting study from PricewaterhouseCoopers that shows that pretty much 50% of supply chain professionals have identified ESG compliance as a key topic, and this trend is growing, long-term being even bigger than short-term. This illustrates that while other items are also very important, the ESG-related topics are no longer stuck within the CSR department walls, but it is now very much a CFO and a CEO topic. So the good news is, even if you are part of the 50% that don't care, the new carbon regulations that have been popping up are going to make you care anyway. And to walk you around those new regulations that can sound a little bit confusing, I'm going to give you a tour of what's going on right now in the EU. So the first thing is carbon reporting. I guess most of you already do that. It is mandatory in lots of countries, and it's mandatory in the EU. Part of an initiative that is called CSRD. If you are watching the news, you might have heard there was a policy change recently voted by the European Parliament. Basically, you will have to report your emissions if you have more than 1,000 employees or more than 50 million euros turnover. So this is a criterion that is easy to get when you're a big company. And this reporting, of course, relates to all emissions, so not solely the supply chain ones. But if you are shipping stuff globally, obviously, your scope 3 is going to contain your global supply chain emissions, and you need to account for those. If you're not compliant, the sanctions will be imposed by the local countries. It can be fines or investment risks for the long term, meaning it's harder to get a loan, it's harder to get funding from VCs, and it's harder for some operational matters that Maxime will present to you later during the presentation. Some of you might be tempted to buy carbon credits. So this is what we call offsetting. Things like buying shares in solar panels or planting trees or restoring mangroves. So while all of those are very good endeavors, the bad news is this is not counted in the scope 3 footprint. So it's something you can do on the side if you have the money and the willpower to do so, but it's not going to reduce your scope 3 footprint. Before we move on to the shipping-related regulations, I wanted to discuss a few other terms you might have stumbled upon. So FIFT or 55, it is an EU framework that aims to have emissions in the EU reduced by 55% by 2030 versus the baseline in 1990. So it's something you will hear a lot if you watch the business news. You have different initiatives that are part of that Fit for 55 package. One some of you might have heard about is CBAM or MACF in French. So this is the carbon value adjustment. This is not specific to shipping. It's basically a protectionist measure to make sure that the carbon intensive industries in the EU are not penalized by the carbon taxes. So if you import steel from a non-EU country that does not have regulations, you will have to pay the CBAM to make this steel from outside the EU competitive in terms of price with what happens within the EU. So it's not a part of, I would say, purely like ocean and road shipping related charges, but it's still something you CFO has very much heard about. And the EU ETS that we're going to focus on the next two slides. So EU ETS is emissions trading system. So it is the EU carbon market. This is a market. So basically the value of a ton of CO2 can vary, go up and down, usually up. And basically it started as something for electric power plants, concrete, steel, all of those carbon intensive industries. But now it's starting to take its toll on shipping, and this is what I'm going to explain to you guys in more detail. So yes, about offsetting, you must also have heard about all those scandals about like double accountancy of some carbon credits. So I would say offsetting is a bit in trouble right now. Again, that does not mean that you don't have to do it, but it's not like the magic answer to all of your concerns. And if you look at what the SBTI, so this is a science-based target initiative, is telling you, they tell you not to take into account those offsetting voluntary gestures for your scope. So EU ETS. So like I told you guys, it's part of the Fit for 55. It started in 2023, and it got implemented for ocean shipping in 2024. So what happens? You get carbon allowances when you're emitting a lot of greenhouse gases in the EU, and ocean shipping lines, so containers, bulk, you name it, have to pay a tax that depends on the emissions of the vessels coming in, out, and within the EU. In 2025, we're talking about 70% of those emissions that are going to be used as a baseline to compute that tax. Where is that money going, you might ask? It is part of the EU border scheme to penalize polluters and push for greener technologies, greener initiatives, and fund innovation on the matter. Something you should know, probably if you have one thing to learn from this webinar, it's this one. Right now, EU ETS is only for ocean shipping and air freight, but in 2027, there will be a newer version of the ETS called ETS2, and on that one, road freight will be also part of the initiative, meaning that there will be EU ETS-related charges for anybody moving freight on a truck within the EU in 2 years. So a nice map to tell you a little bit how EU ETS works. So basically, you get taxed on everything within the EU, so 100% of what happens within the EU. And then you get 50% of the emissions that are taxed before coming into the EU and after being in the EU. So the bad news is, if you come from a long way, let's say East Asia, and you are going around Africa, and this is a long way, the baseline is going to be big. If you are going from Southampton to Antwerp, it will be much better. So what happened in 2024? So EU ETS back in 2023, everybody was anxious. What is it going to be? It's going to impact my P&L. But it happened at the exact same time when the Red Sea crisis unfolded. So freight rates went up the roof. Everybody was just worrying about getting their boxes on a ship. And as such, it got almost invisible at the beginning of 2024. And during most of 2024, it was not that big of a topic. So if you look at the table on that slide, you will see that last summer, if we look at the basic freight rate from Shanghai to Rotterdam for a 40-footer, the EU ETS charges were in the vicinity of 0.4%. So it's not neglectable, but it was small. Now, in 2025, the baseline has gotten bigger, from 40 to 70%. The market has gone down, and the trips are longer because all the Asia to Europe ships are going to Africa. So the contribution is much bigger. So now it's 3%, and it's going to keep going up. So what have the carriers done? So obviously, they did not take those charges as part of their net profit. It's something that they invoice to their customers. So usually what they do is they have a flat surcharge that depends on the trade, and they just invoice it to you as a surcharge, like a bar for THC or something like that. Of course, usually it's very rough, like, okay, Asia to Europe is this much, and that's it. So that means that there is a lot of room for carriers to make money out of that, the opacity behind the calculation of those charges. It's a bit like the new DNDs, but it's something that you don't really pay too much attention to because it is a pain, but at the end, you have to pay up. At the same time, can go back to the slide before, please. At the same time, some carriers have been inventive and they added calls before North Europe to alleviate the charges they have to pay. For example, we see a call in Tilbury in the UK before going to North Europe, or one on Felixstowe. Obviously, those carriers, they do not reflect the lowering of the charges to the customers. So that's why you have to be super vigilant, and the carbon visibility will help you. You might also have heard about the Fuel EU maritime norm. So this one is brand new and started January 1st of 2025. And it's also part of the Fit for 55 package we discussed earlier. So this one is related to the carbon intensity of vessel. That means the carbon content of the fuel that is being used. The baseline is, I would say, a regular heavy fuel oil that is bunkered on most big ships. And basically, the idea is that every year, the percentage of low carbon fuel will need to go up to make sure that the intensities of the carbon will go down as well. So in 2025, it's very small. It's 2%. So 2% of the fuel needs to be low carbon. So bio-LNG, methanol, used cooking oil, there are others. So it's not big yet. But if you look at the graph on the right-hand side, you will see that it's only getting bigger. And we're talking about almost like 50% in the 2040s. So the 2040s are a long way around, but you should know that a vessel's shelf life is usually like 20, 25 years. So that the carriers are getting ready for this right now. And the cost, obviously, will be passed to carriers, to shippers. It's a bit like what happened when the low sulfur regulation came into play in 2020. And in the end, it's always the shippers and the forwarders that pay. So fuel EU, like I said, is going to be 2% in 2025. You will see that some ocean carriers are mixing the ETS and the fuel EU charges in one single surcharge. So as you saw, they're not really computed the same way. So it is a bit of an opaque way of mixing those two together. So they are harder to question. Some carriers, especially the big European ones, have started to offer incentives on the biofuel products. And they will diminish the fuel maritime charges if you buy the biofuels, which makes sense because they don't have to pay taxes on biofuels. So this is why. I will maybe end this bit on fuel EU with this quotation from Lambert from Ocean Score. Right now, fuel EU is 1/3 of UTS cost, so 1/3 of 3%. So it's okay. In 2030, it will be the same thing, so 6%. And in 2050, it will be much, much, much bigger than ETS is. So imagine having to switch the global supply chain from a fossil-based heavy fuel oil to some low carbon fuel that we don't have a steady supply of. It will be something big. So I hope this was clear and shed some light on those regulations. Now, what interests you is, okay, I'm going to have to pay taxes, okay, whatever. How can I leverage this to make my business thrive? And so coming with exciting answers is Maxime.
Thank you very much, Paul. And indeed, let's continue by illustrating how carbon, of course, became a crucial financial issue for company, but can also become an opportunity. First off, quick first slide around carbon taxation. As everybody knows, this initiative is being implemented worldwide and taxations are about to be enforced. If we take it from a global standpoint, carbon tax value differs by country. In Canada, a ton of carbon is 80 Canadian dollars. In Sweden, a ton of carbon is 140 euros. In the UK, it's 18 quid plus ETS participation. So it differs per country. Nevertheless, the price of carbon keeps on increasing. And of course, this was highlighted by Paul. If we take the example in France, we started at 7 euros a ton and now are at almost 50 euros a ton. If we follow this great graph from Lambert on the right side on the screen, we are identifying that the ton of carbon will reach an average value of 100 euros per ton in 2030. So if we put it a little bit into perspective, depending on your business, carbon emissions can have different sources. If you work in distribution or in retail, transportation can become a strong source of your company emissions. For instance, one of our specialized retail customers emits up to 3,000 tons of carbon per month through transportation, which, if we add everything up, can become a significant tax or lead to a significant tax. Such amounts highlight the necessity of consistent and accurate carbon reporting, as carbon emissions can become a strong cost center. So, decreasing carbon emissions can be seen as a way to be less punished with taxes and extra fees. Indeed, as we highlighted, and shipping on all the vessels is becoming more and more expensive, and such principle will also be implemented in road freight in 2017. So decreasing carbon emission is a lever to decrease incumbent taxes. Yet the main question we all have is, why should I do it now? Well, investing in carbon reduction and reporting can be extremely beneficial for companies, and we'll go through some illustrations together. Let's first highlight some new capabilities or initiatives on ocean freight. One of the most important problems to solve nowadays in supply chain is port congestion, because it increases transport times, transport fees, but also limits transport capacities. Investing in greener transport through greener vessels or greener fuel can be leveraged in improving your transport. An example of these are the ports of Singapore, Rotterdam, Long Beach, or Milwaukee, which decrease port fees for greener vessels. Another one could be the implementation of green corridors. A green corridor in the maritime industry refers to a shipping route where low or zero emission vessels operate with the support, of course, of infrastructures, policies, and incentives. These green corridors can be found between LA and Shanghai, for instance, or Singapore and Rotterdam, and can lead to great benefits, such as we saw earlier, decreased port fees, port call automation, which would lead to decreased time in anchorage and at port, which will impact both transit times and cost, triggering major cash flow benefits. These are only two of many examples of how decarbonization can benefit companies. Let's now take another point of view and look at decarbonization and carbon reporting as a financial opportunity or a financial tool. And to highlight this, let's address a couple of green financing items. Carbon-related finances or financing tools have been on for the past 15 or 20 years. You can find green bonds where we have a fixed income. It's a fixed income. It's a financial instrument which is used to fund projects which have green benefits. Green loans, which are loans made for sustainable and environmentally friendly projects, such as reducing CO2 emissions or investing in a solar park. Sustainability-linked bonds, which are bonds where the interest payment is linked to ESG targets and fulfillment, but also publicly communicated. But here, a study from the International Financial Center highlights another item that is now being favored by companies. It's called the Sustainability-Linked Loan, which I will call an SSL for the rest of the webinar, which follow the same principle of the Sustainability-Linked Bond, but they are flexible because they don't have to be solely used on green projects, but will still follow the same ESG incentive, yet do not need to be publicly communicated. Such financial tools, these SLL, have already helped in mobilizing several trillions of dollars worldwide. Example of companies that have been shifting toward SSLs in order to improve finances. You have Vodafone that secured a loan with the Citibank, the green loan, SSL loan with the Citibank, aiming at reducing scope 3 emissions and technically opening finances to their suppliers so they can invest in greener means of transport. Automotive is always the head spear of these kind of things, and they've been Volkswagen or Mercedes have adopted SSLs 2-3 years ago and have managed to secure over $15 billion like this. Last but not least, transport companies are also eligible for SSLs. A good example is Yusen Logistics in Vietnam, who secured a sustainability-linked loan with the MUFG Bank, where transportation GHG emission decrease will be the main indicator of success. So, how can a company be eligible to such loan? First, you need to set a sustainability performance target. To give you an example, Koenig-Nagel, who secured another SSL of 1.2 billion, gave the target to reduce scope 3 emissions from transport partners by 33% by 2030. Carrefour did the same thing with an almost 4 billion loan, aiming at with the target being reducing CO2 emissions by 30%, as well as improving the usage of glass cycle packaging, for instance. So you need to have a target. Then you need to be able to provide an auditable ESG reporting, which contains emissions reporting. We're talking about €1 billion there, or $1 billion. Auditability is key to be eligible. You, of course, need to accept rate adjustment based on ESG performance. The greener you go, the best the interest rate will be. You, of course, need to align industry standards around reporting, and also need to be able to provide an ESG rating that goes from AAA to CCC that can be given by a consulting firm. Once these 5 items are checked, then companies have access to rewards and discounts on interest rates. An example here is the Nordea Bank that highlights that the discount can go from 3 to 7% of the interest rate. The Turkish Yapı Credit Bank provides a discount of 3 points out of a 240-point basis. All in all, it ends up with an opportunity to secure discounts up to minus 0.2, 0.5% out of the interest rates. Take a step back, 0.5% of a 2 billion loan. So decreasing an interest rate of 0.5% of a 2 billion loan can become a significant amount of money, which becomes at the end cash flow improvement for the companies. I'd like now to address how carbon emissions can impact top-line revenue. We all know that consumer habits are changing, so let's try to put some metrics around them. In a report done by the consulting firm Simon Kucher & Partner called Consumer, a Key Player for a Sustainable Future, which was based on a survey sent about consumer habit to over 10,000 persons in over 17 countries across all generations. Well, the results of this study are pretty interesting. First of all, 63% of customers, so the majority of them, consumers, have made changes towards more sustainable purchasing in the past 5 years. And this sustainability is important regardless of the vertical. Additionally, sustainability has been identified by one consumer out of 4 as one of the most important criteria for a purchase decision. Additionally, if we introduce the concept of sustainability premium, which means the willingness to pay over twice as much of money for a sustainable product or sustainable service, well, if we take a closer look at this study, we can identify this willingness to pay is global, with of course USA, Brazil, and EU leading the way. But the most important thing is on the right side of the screen. 1 out of 3 millennials or Gen Z consumers are willing to pay for sustainability premium. These are the consumers of tomorrow, highlighting that company needs to shift to decarbonation and reporting to ensure growth in the next 30 or 50 years. All in all, 1 consumer out of 4 is willing to pay for sustainability premium and improve company margins. Now that we've seen a couple of metrics of how carbon can impact finances, let's highlight some of the best practices our customers are achieving towards CO2 emission decrease. Let's first, of course, focus on Scope 3 emissions, which is what we're here for. What we have seen in the past year, either at Searoutes or Shippeo, is that carbon reporting is often managed locally. It is managed, but managed locally and follows local frameworks. Fred 21 in France, for instance, Smartway in the US or Canada, Linen Green in Belgium, for instance, which enables, of course, good local emission visibility, but have a lot of limitations. First off, it doesn't provide comparable metrics from a country or a region to another, making it difficult to be included in the global sustainability report if your company is operating in more than 1 country. Second of all, they do not always follow an ISO certified standard, making auditability of the report tough, but also providing compatibility issues with other calculators. They also do not cover all modes of transport, and they do not take into account the difficulty of data collection. So the first best practice we want to highlight here is to rely on a global framework such as the GLEC framework. Such framework was developed by the Smart Freight Center and follows the ISO 14083 standards, which enables a standardized and consistent method to compute Scope 3 GHG emission globally by following an auditable approach and by providing ways to simplify reporting. Give you an example, if you're missing a data point in your report on specific transport, the framework will allow you to take hypotheses. The second one is the coverage of all modes of transport, such as air, rail, sea, road, but also multimodal transport. So it's the right framework for transport emissions. It's also aligned with the GHG protocol or SBTi, which ensures compatibility with corporate reports and strategies, but also enable regulatory compliance, such as CSRD in Europe or California SB 253, and thus could become or can become an important tool to secure green financing. Once a good framework is chosen, it's simply to follow the same basis of continuous improvement. First, you plan your improvements, you implement, you follow the benefits and track reductions in cost impact, and then you run a report to highlight improvement as well as identify new areas of improvement, which is a pretty standard approach. on which we would like to add a final step, which is communication. Let's take another step back. In a white paper called Consumer Care About Sustainability and Back It Up with Our Wallet from Maxime company, which was a study made in the US based on 600,000 SKUs representing almost $500 billion of retail revenue across almost 50,000 brands. Well, this white paper highlighted interesting things. The first one is that consumer spending is shifting towards product with ESG-related claim. So product with ESG-related claim accounted for more than 50% of overall growth. Of course, we're afraid of greenwashing. Communicating is key, especially when you do the actions behind. We also see that this trend is visible across all segments, putting ESG-related product at the center of growth strategies for retail companies. Additionally, product meeting multiple types of claims grew almost twice as fast as products that made only one. Once again, and I'm going to say it again, communication is key. We all make decarbonation actions. We don't communicate enough around them, but this communication can impact even our own very own purchasing habits. Now, let's put it in practice and have a look at a customer who implemented transport visibility and carbon visibility. Here, it's a customer producing optics and cameras. Fortunately, we could not disclose their names, but they chose RTTV and carbon visibility with Shippeo, and of course, which is powered by Searoutes. First off, this customer was facing multiple challenges, such as customer experience that had to improve to ensure customer retention, high efforts to track shipments in transit due to the multimodality of the transport, the high number of partners, but also the global aspect of their supply chain, low levels to adjust freight rates, but also the need to comply with company sustainability reporting requirements. They then chose Shippeo, which was of course deployed globally on all modes of transport. Once consistent data was collected and managed in Shippeo, they activated the carbon visibility module, which within a day, and it's something to keep in mind, enabled them to report consistently and in a timely manner on Scope 3 carbon footprint, enabling them to report and track their decarbonation plan. They are now moving towards this final step we addressed, which is leveraging this carbon emission data and the result of their improvement plans in negotiations and sales discussion to create value out of them. Once again, by just communicating to their customer about it. So, which this will be the final step of the webinar, it's to understand, okay, what's the solution? How does Searoutes and Shippeo help in the decarbonization plans? So, it all starts with visibility. Indeed, thanks to Shippeo technology, you are not only able to track and monitor your transport, but you are also able to automatically collect enough information to compute your carbon footprint, once again, in an auditable way. Visibility will help you understand how shipment was managed, which mode of transport was used, the weight of the shipments, the means that were used to carry out your shipments, the distance traveled, the behavior of the delivery, and many other pieces of information. You can see here in this slide the results of visibility on road, air, and intermodal shipment, for instance. But this is not enough. Additionally, Shippeo and Searoutes will also collect information about the means which took care of your transports. This provides best-in-class accuracy in emission reports. You are not only able to use transport behavior as the main entry for your report, but also you can use the fuel type, the capacity of the transport, the mean size, and so on. There, Shippeo and Searoutes will do the magic. Shippeo will mesh your shipment data, the data from your carriers, but also the behavior of how the shipments were delivered. Shippeo will clean the data, ingest everything, transform the results of visibility into a query for Searoutes, which is automatic, per shipment, asking Searoutes, okay, this shipment with these means and this type of transport has been delivered. Please give us per shipment, per delivery, an emission and an intensity. Shippeo will reingest this data, provide these metrics into a reporting tool, which will showcase in a couple of seconds, but also be able to share this information with other systems. It can be your global report. It can be BI tools. It can be TMS. It can be customer portals. It doesn't really matter. Shippeo is able to expose per delivery the footprint of the data and giving you access to display this data. Let's conclude this webinar with a little tour of Shippeo carbon visibility. Up. All right. So it all starts, as we said, with transport visibility. We have here a shipment going from the US to Montreal, Canada, which was delivered according to the plan, meaning it seemed that the behavior went okay. But also Shippeo has identified, thanks to the real-time tracking, the distance that was traveled, not the expected distance, but the real distance. Additionally, Shippeo has also collected information about the truck. Well, this transport was managed in HVO. This is a tier 2 type of engine. This is more or less an old truck. These are important data to improve the accuracy of your footprint and of the reporting. When this information is collected, well, you can access to your reports directly from the platform. In one click, you will get access to, of course, your emissions, your intensity, but also information of where you have room for improvement. First off here, we see that we have a high intensity for low tonnage, the high intensity for high tonnage, whereas shipments with the average tonnage, is managed in the right way. We already know where to start. Shippeo will report on your transport quantities that you're already using to compute your reports, maybe in the framework you're using today. What is interesting, it's also going to be able to report on the type of fuel that is used on your deliveries. You might be investing or co-investing with your carriers on biofuel, electric trucks, and you want to make sure they are used for new deliveries. This is a good way to see reports and to see if your biofuel is actually used. Shippeo will also highlight your hot zones and your cold zones of your global footprint. Here is a good example of the global aspect of the GLEC framework. Can compare emissions from a region to another. We have here a customer having a lot of operations in Northern Europe, in Europe and in the US, and some deliveries in Africa, Oceania, and South America. It seems to be here that America is paving the way towards green transport, whereas Europe is lagging behind. Let's focus in Europe and maybe drill down to the right lane or to different lanes to start optimizing them one by one. Here is a global report with comparable metrics. Last but not least, Shippeo is going to give you the possibility to bench your carriers one another, your customers, your sites, it doesn't really matter, in order to understand who has the biggest impact or the biggest impact in your carbon footprint, with which carrier do you need to start, but also with which customer you are able to start communicating upon on your carbon footprint or the carbon footprints you are providing on their deliveries. This will end the demo of Shippeo. I hope you enjoyed the tour.
Perfect. Thank you so much, Maxime and Paul, for these insights about carbon emissions. So maybe just to wrap up, and all participants, please, now it's the time to ask the questions, because I'm just going to give a short conclusion and then we are going to start the Q&A session. So maybe if I summarize it. First of all, supply chain disruption will continue, and this will still, like, it's something that's happening. It's going to maybe accelerate, etc. And the mandate of the CSCO has changed, where sustainability is now a much more important component. Secondly, what we've seen is that that carbon regulations are becoming stricter and more enforced. Then a topic that we covered was that it's not just a CSR topic anymore. There is a financial impact that is linked to it. and that it can be really a differentiator for the company. So I guess this is like a high-level summary of what we heard today from Paul and Maxime. And maybe the last thing is that you can get the data on your scope 3 emissions through the collaboration that we have with Searoutes via our platform. And that was the demo that Maxime did. So let me check the questions. So don't hesitate. We still have a little bit of time to ask the questions. And so first question that I can see. So could you share some pragmatic best practices to improve companies' carbon footprint? So who wants to go? Maybe Paul, you go with this question?
Yes, absolutely. So the first order of business is probably something you already do. That is, you have to make the best use that you can out of your freight options. So you fill your containers better, you fill your trucks better, less empty miles. So this is something I guess most companies do naturally because there is also a cost-saving aspect to it, but it is really the first thing to do. Once this is done, so it might be tempting to switch to buying biofuels or carbon credits. But what we recommend instead is that you actually deep dive into your emissions, especially if you have a global supply chain operated. You might want to see where you want to focus first. You cannot do everything at once. So you need to focus on what's important. And I don't know, you might be using Shippeo or Searoutes to do that, just an idea like that. So you need to focus on some areas, some trades that will make a big difference. The first thing that you can do, obviously, is try to change the modes or transportation that you have. So I know it's easier said than done, but for example, air freight is on average 100 times more emissive by ton kilometer than ocean. So if you are moving things by air because you are used to it, or because you always have like shortages, so you need to rely on air freight for quick delivery. So you might want to have a chat with your supply chain managers, like, okay, what can we do to secure the supply and switch to ocean because it will be cheaper and it will be greener. Same thing if you're moving freight over long distances using old-fashioned diesel trucks. Maybe it makes sense to switch to rail plus road approach or barge plus road, or to ask your road carrier to use HVO or biodiesel blends, things like that. And the good news is you can simulate and you can assess the results of those different initiatives using Searoutes and Shippeo. So it is pretty neat. And you will see all of those scary red dots get greener. So it would be satisfactory. So then if you're like really motivated and your CFO loves the environment, you can go for insetting options. So insetting is basically buying biofuel that will not be used on the vehicle that you are shipping on, but your transporter will have a third party, usually an auditing cabinet, that will make sure that the emissions from the low carbon fuels will not be counted twice. It's a bit like when you buy green electricity. So we're not changing anything on your setup, but you get attributed the emissions from some greener power plants. So, for example, if you're shipping on ocean, you can come knocking at MSC, Maersk, CMA, all those guys. They all have services for insetting, and this will reduce your emissions drastically. And the last thing you can do, but it should be the last thing you do, not the first, is if you want to be like carbon neutral, is to purchase offsetting options, so carbon credits, and be really careful about what you buy. And make sure that the project you invest on are serious. Any activity, freight activity, whatever, emits carbon. I mean, even this webinar is emitting carbon, even though the French electricity grid is very green, but it still has a carbon footprint. So if you want to be carbon neutral, like totally, you will need to compensate some hard emissions using carbon credits. But since it is expensive And as we saw together, there is a bit of uncertainty around how emissions actually going to be accounted. Something you should do as a last result. So yeah, but first thing, operational excellence. I guess something you already do. Keep doing it, and then visibility to go for the low-hanging fruit and do those supply chain remodelings to make sure your emissions go down.
Perfect. Thank you so much, Paul. There is a question, also a pragmatic question. I like the pragmatic questions. And I think this one goes to Maxime. And this is like, are those dashboards available for different modes of transportation, not just truck?
That's a good question. These dashboards, have you seen, are available today on Shippeo on ocean transport and road transport, regardless of the mode of road, and will soon be available in other modes of transport.
Okay, perfect. And there is a second question, and still very pragmatic, which is about how does Shippeo collects the data? And for instance, a question about the characteristics of the transportation means, like how do we get the truck type, fuel, and also can those information be verified?
That's a good question. So the way we collect these informations are collected by Shippeo is by going to fetch them where they belong. They belong on the carriers, okay? So if we focus on road transport, transport means and characteristics, are only known by the carriers that are operating the transport. In order to be able to fetch this information, they're onboarded on the platform and they are given a way to report on their truck's characteristic. It can be your carrier level 1 all the way to the last subcontractor. Inputting this information in Shippeo can be done in multiple ways. You have, of course, manual updates, which I will not detail today, but these can be automated by getting this information directly from the TMS of the carriers, for instance, or even from the telematics that is within the truck. So these are the ways to collect the information, yet to verify it, we do not paste the fuel within the trucks before the information is imputed. So it's up to you and your carriers to verify the veracity of the information. Nevertheless, regardless of the veracity of the data, your report on Shippeo powered by Searoutes will still be auditable. It can still in any way be used for communication, finances, or any other purposes.
And if I can add a bit of response on what Maxime said, when you're a company and you confront it to those mandatory carbon reports that you have to process, usually the first solution that comes to mind is getting all those data from various TMSs somewhere, get an Excel file, get the intern to run a macro. So it's very manual, so it takes time, but it is hard to audit. Because you don't want to imagine yourself explaining to an auditor how that process was made and the data quality you get at the end was average at best. The beauty of having Searoutes data within your visibility provider, so Shippeo, is that they take care of the dirty work for you. They will get the telematics data from the road carriers. They will get the vessel names from the ocean carriers. They would get the sailing date so that you have voyage-specific emissions and not just like something generic. So all of that would be taken care of in the background. And since it's reconnected to Shippeo through API, it's very transparent. I mean, there is no manual tinkering on the data. So what we know what you put inside of the engine, and we know what comes out. So if you're an auditor, it's really easy. And Searoutes recently got like certified for the ISO 14083 full compliance. So it's like the highest global standard for how freight emissions are being monitored. So for an auditor, it's really easy. Like, okay, I know what the input is. I know where Shippeo gets the data from. Searoutes, I know you do your calculations well. I know what comes out. The structure is always the same. So it's super easy to audit. And it is a guarantee that any endeavors you will take carbon-wise, you will see the results. And it's not going to be just, okay, I change the column in the Excel file, so we have to do it all over again.
Perfect. Thank you so much for adding a bit more color to it, Paul. And thank you so much, Maxime, for this answer. So yeah, basically what I understand is like there is a lot of automation going there in the background, so it's much more secure. So there's another question, and I think it will be for you, Paul. How can carbon visibility help us mitigate carbon-related charges?
So this is a great question, a tricky one. Basically, when you run ocean or road freight emissions, if you use averages, like most people that are not using specialists are, you will get the same value regardless of what you do. So if you are shipping from Shanghai to Long Beach, it doesn't matter if it's MSC, CMA, HAPAG, Evergreen, you get the same number because there is only one distance between the two ports, so you get that number and that's it. If you go deeper into carbon visibility territory, you will get emissions that are specific to voyage, specific to a vessel, specific to a service. So if you are shipping with a greener carrier, it will show on the numbers. And if you are shipping with a dirty carrier, it will also show in the numbers. So when your carrier is the one paying the EU charges that we discussed earlier today, but they will be, like I presented, most likely be giving you the same value regardless of the vessel that you shipped on or the service that you use. So let's say Maersk has two different services from Shanghai to Long Beach. One is very carbon intensive, the other is greener. You will pay the same amount for both. So if you only use averages, it will make sense because, okay, I did that, and so it is consistent. I mean, there is the same proportionality between the two. If you have carbon visibility, you can have lots of interesting conversations with your carriers. Like, okay, I don't understand this one. I see 2 tons reported, and I paid 50 euros for TU. This one, it was 4.5 tons, and I also paid 30. So obviously something is wrong here. So if I am getting slots on greener services, if we agree during the tender that we'll be using those vessels, those services, I need it to be reflected in what I get. Same thing if you use biofuels or if you use lower carbon alternatives, you will be able to see it with Searoutes and Shippeo. Like I said, the ocean carriers, they should not be charging you full amounts for those EU carbon taxes if you're purchasing biofuels. So thanks to Shippeo and Searoutes, you can have like end-to-end visibility on what you actually been shipping on. And if there is something funny, it will be much easier to see it.
Thank you so much, Paul. I think we have time for a last question, and this is going to be a broad question. I think this one is for you, Maxime, but the question goes, does Shippeo do only carbon emission dashboards? And if not, what else, what kind of other data can you provide?
That's a good question. So first of all, Shippeo is a visibility platform. Carbon is an addition. Carbon visibility is an addition to the visibility platform. So by default, Shippeo can provide a wide set of data to companies based on tracking data, information of deliveries, collection of documentation, ETAs, when is the shipment going to arrive regardless of the mode, the possibility to share this information. Technically, it's a system that is able to answer to any TMS on transportation statuses and expected transportation statuses, and maybe surcharges that might occur based on also the fact that Shippeo is predictive. It can predict what's about to happen on a shipment. So the set of data is RTTV data that is being able to be shared with companies. We haven't addressed carbon yet, all right? Second set of data that is made available is the carbon reporting, which is technically the last step after a shipment is delivered. Shippeo will report to our customers per shipment, as we said, through a dashboard, but also give you on every shipment a payload, standard payload around the intensity, the footprint of your transport, as well as with the transport quantities, the speed, the distance that was traveled, and so on. Meaning for every shipment, Shippeo will not only provide the dashboard, can provide you the unique data on top of providing you with all the benefits of transport visibility. I hope it answered the question.
Yeah, I think we can go on and talk about this.
Yeah.
So I think I've covered all the questions. If anyone wants to add the last question, it's the moment. But otherwise, I will start wrapping up and closing this. Thank you, everyone, for joining us today. And of course, a special thank you to our speakers, Paul and Maxime, for enlightening us and giving us their perspective on carbon emissions. So it was a really big pleasure for me hosting today. And for all the participants, don't worry, you'll get the recording of this webinar in a few hours or in some days. So check your email box for the recording. Thank you again, everyone, and have a great day. Bye-bye.
Thank you, everyone.
Bye.